Welcome. Today we're going to discuss partnerships. Now, partnerships is an important topic in accounting. A partnership, by definition, is an agreement between two or more parties who have pooled their business interests. And they have this primary objective of making a profitable return from that investment. So basically, they put all the money and the other assets together in one little business, and they're all hoping that they can get a share of the profits that would be made. Now, in order to avoid confusion or complications in the future, it is advised that partners draw a contract, or what we call the partnership deed, to formalize the agreement. And that is because where there is no formal agreement, the Partnership Act states that all profits or losses must be shared equally. Now, what should be inside this agreement? Well, amongst other things, the agreement should show the agreed capital contribution to be made by each partner, because persons can't just turn up with any amount of money and say, well, I in this partnership. There has to be an agreement as to how much each person will contribute. Secondly, what is the rate of interest payable on that capital that the partners are investing, right? What we call the opportunity cost. That is what they would have had to give up another opportunity to invest in this business. So you got to give them a little something for doing that. So what is that rate of interest that you're going to pay them for doing that? Thirdly, I guess very importantly, what is the method or process of sharing the business's profits and or losses? Right? So what's the ratio, the percentage, the proportion? How are you going to do it? All right. How does each person get their share of the profit? Next would be the rate of interest that they'll have to pay on any drawings that they make. Now remember, drawings reduce capital. So there's a penalty, right, that's going to be imposed for withdrawing the capital that was available to run the business. So that would be your rate of interest on drawings. The fifth thing, not in any specific order, would be who gets a salary and or a bonus. So in normal thinking, the partners who are doing the work are the ones who get the salaries, because salary is what you earn for the work that you put in. So those partners who are not contributing any labor at all to the business should not be entitled to a salary. But all the partners could get a bonus. All right? They can get a bonus. But lastly, what we will look at would be what is the method for admitting new partners to the business or removing old partners from the business. So all that should be in the partnership agreement. And let me explain the concept of fair value assessment, because when all these different individuals bring their assets and liabilities and so to the business, it says, according to the rules, right, those assets and liabilities being transferred by the partners to this new business venture should be recorded at their fair values. And a fair value is simply the amount one would expect to obtain for the asset under the current market conditions in an arm's length or legal transaction, above board transaction. Right, so what then is required to actually get this partnership going? Well, from an accounting perspective, an entry will have to be made in the general journal to establish the transfer of the assets and obviously the liabilities to start off the new business. So basically, what would happen is there's an original entry. The journal obviously is where the original entry is. And what happens is you have to record the value of the assets as well as any other liabilities that were put into the pool, and then assign the capital values to the partners according to how much they invested, right? So your journal will look something like this, right? Where all the assets are listed in the debit column and the liabilities and the capital will be over in the credit column. Okay, so the difference then that we're going to need the appropriation account. So an appropriation account would have to be created to record the distribution of the profits and or the losses, whichever occur, made by the business to the partners. And then you would need a current account, which would also, you should also have to create, because it doesn't exist right now, to record the change of equity of each person in that partnership. In other words, how did they benefit from the investment in the partnership over the period being reviewed? Okay, so what we'll do, we'll examine the appropriation account in our next episode. So I will see you then. So this has been produced in association with TV Barbados. So we will see you next time.